All right, guys, welcome back to the channel. This is the channel where we teach dentists and doctors, busy professionals, and anyone that's interested in learning and investing in real estate, the principles of how to achieve financial freedom through passive investing in real estate. My name is Jonny Walker. I'm a successful endodontist as well as a self-made millionaire in real estate investing. Today is a very special day because today we are going to be having our very first guest that we're going to be interviewing. And this is a very special guest. He is the principal, founder, and president of Proud Living, which is a vertically integrated multifamily real estate company. TJ Caleca, welcome to the show.
It's my pleasure, buddy. Thank you for having me.
Absolutely. So it's been a long time coming. TJ is one of my mentors in multifamily real estate. I learned a lot from him. And so we want to have a very frank discussion about multifamily real estate. And perhaps he's going to share some strategies, share some tips on how we too can build immense wealth through investing. Can you talk a little bit about why you feel that multifamily real estate is a risk mitigated strategy?
Sure. It's very simple, right? People need to live somewhere, and I think obviously you could get sort of into the weeds and you could say, all right, well, people don't have to live in $3 million homes. Yes, correct. People don't have to live somewhere. It doesn't always translate, to every piece of that meaning. But the reality of it is people need to rent apartments, right? People need to live in reasonably priced housing. And I do say to some of my investors where, don't take this like the wrong way, but we want to own the best of the ugly, right? We want to own the pretty of the ugly. We want to own the highest of the low. We want to own the most expensive of the cheap. We want to be the prettiest girl on that block. I have no interest in, building high rises in Midtown. It's not what I do. It's not, it doesn't excite me. I want to own as many properties as humanly possible in a space where the margin for error, really is high, right? I mean, I want to have the ability to make as many mistakes as humanly possible and pay the smallest price. And ultimately, when you're buying value add real estate where someone needs to live there and your cost basis is low and the rent is relatively high compared to your cost basis, you're going to do okay. Someone needs to live in an apartment for $1,500 a month. Someone needs to live in an apartment for $1,650 a month. Someone doesn't need to live in an apartment for $7,200 a month. The market goes up, that's great. People hit the lottery, they can move into that $7,200 a month unit. But when the market gets bad, I'm going to catch all the people coming from the $3,200 a month unit, from the $2,800 a month unit. They're going to come into my buildings. In a bad market, my audience becomes greater, not, smaller. In a bad market, the opportunity for me to cater to people that need affordable housing and reasonably priced housing gets better. I would argue that my business model does better in a bad market than it does in a good market.
There's a lot of stuff to unpack there. I still want to get back to how you went from a few units to 2,000 and how the scale, when it started to scale. But before we go there, we also love the value add space, right? The value add space, as you said, there's room for mistakes. I want you to elaborate a little bit on that. But before we get to that, it seems like you're saying that the value add space is even more desirable from an investor. I mean, you're an investor, clearly.
Sure.
From an investor's perspective than a luxury. And if you look, or class A, as it's called in the multifamily space. So you seem to like the class B to class C, class B, that in that area, right? So if you notice 10 years ago, cap rates for class A property was always in the 5-6 range, and then you had value add that was trading at 9 and 10 caps. Now all of a sudden it seems like because there's so much competition for these value add properties, the cap rates have come way down on value add versus, almost to the point that it's the same as class A now. Is now a time that we might look at light value add class A that we might be able to get at better prices? Let me let you answer that first, okay? And then we'll go on to a couple other things that I want to get from you.
Yeah, I think value add really is The emphasis on a value-add strategy is all about the person that's operating, right? So the sponsor matters. Their ability to execute, their wherewithal within a given market, their relationships with the communities. The sponsor matters in every investment, right?
And what is a sponsor? Can you just tell us what a sponsor is as well?
Sure. So, Proud Living would be a sponsor. I'm the sponsor in my deals. The sponsor is the entity that is ultimately driving that investment. So in any investment, it matters who you're giving your money to. In an investment where, I'll say the lift is a little bit heavier or the value add strategy is more intensive, obviously then the work is a little bit more difficult. The sponsor's, reputation and their ability to maneuver matters more, right? When you give your money to TD Bank to go to an extreme option, they don't have to do anything, right? They have no operational, prowess. They take your money, it sits and it makes nothing. Right?
And then they lend it at 10 times of what they're
Then they lend it out, right. But if you want to give your money to somebody who's going to return you 7%, 9%, 12%, 15%, 18%, 22%, there's a cost factor there because obviously there's, some perceived operational risk. I think the sponsor matters. The value add opportunity on a Class A deal, not to go off on a tangent, but is going to be much more difficult for most individuals to get into. Right? Everybody wants to put their money into a Class A deal, supply and demand. So if I have a Class A deal and I'm raising money, I can get money from every institution out there at 4, 5, 6% interest. There's so much desire to get into that sort of an asset because the perception is that it's easier, it's safer, right? Now, if I want to make money as an investor, I don't want to make 4, 5, 6%. I'm not making any money, right? You have to have, in my opinion, $100 million in cash to be able to make 4, 5, 6% on your money. You're not growing your portfolio. You're just mitigating, losing capital. So if you want to,
you're trying to beat inflation at this point,
you want to preserve whatever capital that you have.
Mm-hmm.
If you want to make 7, 8, 10, 12, 15% returns, you're not probably investing in Class A.
Right.
You need to go a step down. And there's nothing wrong with that. It doesn't mean that, number one, it's more risky. It doesn't mean it's more dangerous. That's all bullshit anyway, right? If you're investing in something, especially multifamily, you need to look at the sponsor, the operator. What have they done? Have they done projects like this? Okay, yes they have, great. Have they done them in these neighborhoods, in these communities, right? Are they investing back into the community? Do these municipalities support this particular sponsor? And then ultimately, you're going to invest, and we'll call it a lower class investment, a C investment, a B minus investment, but that's why the returns are going to be 9, 10, 12, 13, 14, 15% as opposed to 4, 5, 6%, right? Your ability for future appreciation is going to be greater because
you have room for forced appreciation as well. With value, with the luxury in Class A, you don't have zero room for that, right?
No doubt. And also in the Class A space, the pricing is much less disjointed. When you get into a B minus and then a C class asset, it's much more fragmented, it's much more disjointed, it's much more opportunistic.
Inefficient
for the right
marketplace,
sponsor.
right?
It's much
That's right.
less efficient, and there's a ton of opportunity in inefficiency.
Absolutely, yeah, I love that. I love that. Yeah, inefficiency in real estate, period, compared to stock market.
No doubt.
As busy professionals, we're taxed to the max. On this next video, we're going to shed some light on what you can do as an investor on how to save money on taxes. Click on the next video.